battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are Stenger Family Office for the past 45 years. It's been our family's mission to deliver you clarity and confidence to help secure your financial future. And why do we have to deliver you the clarity and confidence? Because it's times like these when everybody wants to panic, everybody's standing on the ledge, thinking about jumping. You call us, and hopefully we will talk you off. We're going to get into it. The show this week is called Dumb Money, and it's a nod to the movie about GameStop investors called Dumb Money. And in investing, there's really two types of investors that people refer to. Smart money, which who knows how smart it really is, institutional money, family offices, portfolio managers, professional money managers, and then dumb money they call retail investors. And I'm not saying that that's true, but there are behaviors that all investors can be subject to, whether you're retail, whether you're institutional. All of us could be subject to basically 7 dumb money behaviors. And what I want to help you do on the show today is avoid those 7 things. Avoid making big mistakes with your investments. And there's really 2 big mistakes that you could make. One, selling off your equities when they're down like they are right now. And number 2, not coming to Investor Day this October and missing Tom Lee. If you don't come to Investor Day this October, you will regret it. And Tom Lee is an absolute legend in the investment industry. You cannot miss this thing. Live in Oak Brook, October 8th and 9th. We are basically at 60% sold out already, and it will get very full. That was off of one email blast. We sent out the first email. 60 people immediately signed up, and we're basically going to probably send out one more email. We're not going to do the mailer this year, and it's going to be sold out. So don't miss Investor Day, October 8th and 9th, coming up in Oak Brook. And if you've never come to Investor Day before, you really should. Okay, let me get into the content of this week's show. And I want to start by showing you where we've been with the market this year so far since the all-time high, and then comparing that to what's actually going on with corrections or what has happened with corrections in the past. Now, this is actually through March now. March of 2026, we are down just about 6% in the S&P. It feels really bad, and it feels terrible and awful until you zoom out. October of 2025, we were down 5%. February of 2025, we were down 19%. You'll remember that was Liberation Day with the tariffs, and then you go back to March of 24, we were down 5%. July of 23, we were down 10%. December of 21, we were down 25. Then you get to COVID, March of 2020, 2 weeks to slow the spread. We're down 32%. You do September of 2018, 15% correction. May of 2015, we were down 10%. April of 2011, down 15%. Do you notice a pattern here with the data? Every couple years, we have a major sell-off. Now, every single year in the stock market, almost guaranteed. The one guarantee you do have in the stock market is we're going to be down about 5 or 6%. That happens literally every single year. Every 2 years is about 10 or 15%. So if you see a 10% correction, and who's been telling you a 10% correction is coming since December of last year, and who also told you it might be Q1 or Q2? Don't have a crystal ball, but we were pretty close. We're down 6% in Q1. Don't be surprised by this. If you've been watching the show, if you've been coming back every week, you are not surprised by the correction we are in right now. So all the texts and emails I'm getting right now, which I will say we are getting more texts and emails, more worried clients now than we did during COVID for this Iran oil spike. We're getting more people nervous in the service right now than we did during COVID. You ask yourself, why is it that people are so worried right now? Why are people panicking? And I would say people are more worried about this correction, the 6% pullback, than they were during tariffs last year when the S&P was down 19. So what can you attribute that to? It's the media. The media is absolutely toxic. It's so damaging. And people that are glued to their screens, they're doom scrolling Twitter, they're all over these news articles and these stories. They are calling us saying the world's coming to an end. And they're trying to change their investment plans. And I say that is just not good behavior in the stock market. The second you start trying to adjust to the media, you are in a losing position. That's called being reactionary. And that's not a goals-based financial plan. So watch out for this stuff. square the reality of what's going on with the data to the narrative. And if you actually zoom out, if you look at a long period of time, you're going to see the 6% pullback is nothing. It's not that bad. And statistically, you're going to have these continue. And if you get to the end of this year and we've had a 10% pullback, we could even have another 5% pullback. You say, how do you know that? Well, just look at last year. Last February, down 19%, market comes roaring back, and we still gave a little bit back in October temporarily. So think about the S&P. We went sub 5,000 points April of 2025. Everybody thought the world was on fire. We finished 2025 positive 17.5% in a year where we had a drawdown of 19. The average stock, this is Peter Lynch, who ran the Magellan Fund at Fidelity, the #1 mutual fund basically of all time. Peter Lynch says the average stock has a fluctuation intra-year of 100%. Think about that. That means the average stock goes down 50% and then up 50% off of that zone it started. The average stock, according to Peter Lynch, has a 100% fluctuation. That tells you one thing. When you're going to invest in equities, when you're going to be an investor in the stock market, what should you be prepared for? You should be prepared for volatility. You should be prepared for corrections. Let me give you an update, Producer O, if you don't mind throwing this on the screen. This is an updated state of the market. I showed you this last episode as well, and this compares the S&P Top 50 all the way through Europe, Japan, China, the small caps and the mid caps. This year in 2026, we are down, as of yesterday, about 6.68% on the top 50, 3.23% on the S&P 500. Mid caps have held up pretty good this year. Small caps have actually held up pretty good. And then you go into international indices. Look at China. China, which was supposed to be the safe haven, it wasn't, is down 6.33%. We told you that. Japan's up a little bit because of the currency. Europe's actually doing okay thanks to the currency compared to the U.S. But as soon as that currency started reversing, U.S. markets have proved to be more resilient, especially when you pan out 5 years, 10 years, 15 years. And so everybody texting me right now about, why aren't we in European stocks? Well, if we did that for the past 5 years, you'd be texting me the opposite thing. Nick, why in the heck did you have me in European stocks the past 5 years when the top 50 of the S&P went up almost 15% a year, and Europe only went up 8%. By the way, China went down. The 5-year return on China is still negative. You have not made money on China in 5 years. So once in a while, these countries will get a pop. You saw it in Argentina. You saw it in Brazil once in a while. You see it in some emerging market countries and some developed areas across the world. Once in a while, these countries will get a pop. The question is, are you investing for a one-off return, or are you investing in a long-term goals-based plan, which requires consistency? The consistency has come from the highest quality U.S. markets. The other thing going on behind the scenes is sector rotation. We've talked extensively about sector rotation this year. Now, since the correction started just a few weeks ago, here are the hardest hit sectors from start to finish so far. Consumer discretionary, these are stocks where you don't necessarily have to buy their products. You buy things when times are good. Those stocks are down 13%. People are worried about those stocks continuing to correct. Stocks like Costco, Amazon, some of those companies that you don't necessarily have to buy their goods. You got financials down, surprising, but financials are down almost 12%. Materials are down 11%. Staples, which you would not think would be on the upper half of that list. Consumer staples like Campbell's Soup down 9% since the peak, and there's technology in the middle, now 9%. And then you follow that up with industrials and healthcare and communication services, real estate and utilities. But here's what's interesting. If you zoom out, where's the return come from? It's been technology. So if you're going to be in some technology stocks and you want that long-term return that technology stocks provide, you're going to have to live with some volatility. Look at consumer discretionary over the long run, been one of the best performers. Look at communication services, companies like Netflix, Google, Facebook. Communication services, one of the best performers over the long run. Yet you're going to have to live with some volatility. That's the price we pay to own equities. Let me give you a couple examples here. And I like the Microsoft example because Microsoft has sold off almost 30% now since the peak. Compare that to the past couple corrections we've had, and you're going to notice a pattern. 2024, we were down 23% on Microsoft. 2022, down 36%. 2020, down 18%. 2008, 48%. This is obviously not a comprehensive list, but one of the things I want to show you is this pattern that emerges. What do you notice here? About every 2 years, you're going to have one of these major sell-offs. If you're going to be in a all-star stock like Microsoft, a face ripper, melt your face off stock like Microsoft, what are you going to have to deal with over time? You're going to have to deal with these pullbacks. You're going to have to deal with times being a little bit scary. What's really interesting is Microsoft today has sold off more than it has or it did during COVID. Absolutely an overreaction, in my opinion. I'm not telling you to buy or sell Microsoft. I'm not telling you to go out and put your entire net worth into it. I'm just showing you an example, the fact that you're going to have to live with some volatility in these stocks. Overreactions do happen in the market all the time. And what's also interesting is you say, well, is Microsoft overvalued? Well, Microsoft in 1999 was trading for a PE ratio of 75. That means every dollar of earnings during the tech bubble that Microsoft generated, you were paying 75 times for those earnings. Look at today. You're buying Microsoft at a forward PE of 19. This is basically like a value stock. And for some context, Chevron now, which has run up with the oil boom here in 2026 and the Iran conflict, Chevron, an oil company which has basically not grown revenue or profits in 3 or 4 years, is trading for 35 times profit. Yes, this is correct. This data is spot on. The fact that you can buy Microsoft today cheaper than you can buy Chevron. So look at the data. Get your hands on what's actually going on. Don't just buy into the narrative and the doom and gloom stories and everything that you read on the headlines. Actually get your hands on the data, because these numbers will eventually drive long-term returns. Okay, let me show you Netflix here. Not a recommendation to buy or sell, but I want to show you a couple corrections on Netflix. We are currently down 32% since the peak on Netflix, but in 2022, just a few short years ago when the Fed started raising interest rates, Netflix was down 73%. In 2018, it was down 29%. 2011, down 75%. If you're going to own a high flyer, a fast-growing company like a Netflix, you're going to have to live with some big pullbacks. I hope you didn't sell it in 2011. I hope you didn't sell it in 2018. I hope you didn't sell it in 2022, and I hope you don't sell it this time. If you go back to 2016, Netflix was trading at a 334 price-to-earnings ratio. Look at it today. Not saying it's dirt cheap. I'm not saying it's the cheapest it's ever going to be. I'm not saying it's not going to correct more from here. But Netflix today is trading at 32 times earnings versus 334 just a decade ago. Here's another example for you. Meta. Meta's currently in a 25% pullback. But just remember, in 2025, just a year ago, it was down 32%. In 2022, you may remember this, Meta went down 76%. You could have bought it for $90 a share. Today, even after this 32% or 25% correction, Meta still trades just under $600 a share. You could have bought that stock for $90 in 2022. In 2020, Meta went down 30%. In 2018, 40%. In 2012, 40%. Its PE ratio in 2016 was 44 times. Look at it today, trading at half of what Chevron trades at. Absolutely incredible. So let me get into the 7 dumb money behaviors. How do you avoid these things? How do you make sure that your plan is protected over the long run? How do you not make the big mistakes that people make in investing? Number 1, stop looking at your account all day long. The digital age has made it very easy to pull up your phone, go to your app, your Schwab app, your Robinhood app, your trading app, and look at your stocks constantly, especially when you retire. Have you noticed this, that when people retire, they start looking at their accounts every single second of the day? Find a different hobby. That is the best advice I can give you. Go do something else. Go for a walk. It's getting a little bit warmer here in Chicago. Get outside, walk your, maybe you should get a dog. Do something else than look at your account every 7 seconds of the day. Stop looking at your account. The more and more you look at it, the worse and worse it's going to be. In fact, the trading apps like when you look at your accounts more. Why? Because it generates commissions for them. So stop looking at your accounts all day. Number 2, constantly changing and I put this in quotes, your plan. Because if you constantly change your original plan, you didn't really have a plan. You just had some ideas. And so you need to have a plan. What's a plan supposed to do? A plan's supposed to be forward-looking, goals-oriented, and it's supposed to be proactive so that when these corrections happen, not if they happen, but when they happen, you're ready for it. You're not surprised. And so if you're our client, you've been with us for a while, and I do notice a difference between clients who have just started with us and clients who've been with us for 30, 40 years. And the clients who've been with us for 30, 40 years, I don't care if they're 70, 80, 90 years old, they don't look at their accounts the same way. They don't panic the same way. Why? Because they've been with us through this multiple times. They know the market corrects and they know the market comes back. It's the newer people that just haven't been through it the same way. So if you constantly are changing your plan, one day you're in equities, one day you're in fixed income, one day you're buying one fund, the next day you're selling it, and you're getting into something completely different, you are going to destroy the return on your portfolio. That is not a plan. That's just reactionary, and you cannot build wealth long-term doing that. And what also goes along with constantly changing your plan is behavior number 3, which is called trend chasing. You just buy the latest and greatest, the hottest new craze, and you put your portfolio into whatever investment tracks that. This happened during the EV craze, the electric vehicle craze a few years ago, and people were buying solar stocks and pot stocks and EV stocks and all the rest of it that goes into it, thinking we were never going to use gas again. And what did we tell you at Stenger Family Office? We're going to need a lot of oil and gas for a while. And I'm sure that's going to earn me a nasty comment on YouTube. Somebody's going to say something on one of the shows. Fine. But it's true. We're going to need oil and gas. Look at Exxon and Chevron this year. Clearly, we need energy. And so when you go out and you pay 200-300 times for a solar panel company, just watch out. You better hope that every house in America is going to have solar panels on it. And if that doesn't happen, you're going to absolutely be left holding the bag when it all comes crashing down. Same thing with the tech bubble when people crowded into unprofitable tech stocks in the 90s. Same thing during the financial crisis when people had way too much money in banks and then the banks started failing. I think today there's probably 3 trends that you need to watch out for that people are crowding into, which I think are going to eventually prove to be the same outcome. Number 1 trend that I think is going to blow up and already is blowing up, private credit. We have been telling you about private credit for the past year and a half now. Watch out. When you see every single person on Wall Street talking about the same thing, it's usually a red flag. And we do our extensive due diligence process at Stenger Family Office every October and November where we interview 20, 30 asset managers. And the best thing that comes out of that usually is we get a sampling of what everybody's saying. And every single person this year who came into the rebalance said, buy private credit, put your clients in private credit. We said, hey, hang on a second. Wait a second. You're telling me you're going to put illiquid assets in liquid investment funds. What does that remind us of? 08 and 09. So we told people, watch out for this stuff. We were tomorrow's news today. We told you, watch out for that big trend chase. Look at international stocks. People watched U.S. stocks outperform for years and years and years, which we told you was going to happen, and it did. And then finally in 2025, last year, the dollar weakened a bit with tariffs, and people crowded into European stocks, international stocks. And I think those people are going to be left holding the bag again, just like we're already seeing cracks emerge in China. And then the last thing, I think now people have really crowded into the oil trade. It could keep going for a while. Exxon's trading about 160, 161 a share. Chevron's over 200. Maybe that keeps going a little bit more. However, I think at the end of it, when you pay 35 times earnings for an energy stock, you're going to pay that price long term, and you could be left holding the bag. So don't be a bag holder. Don't be trend chasing, because that's what happens to people. Number 4. Buying high and selling low. This is very intuitive. You would think to yourself, of course I wouldn't do that. I want to buy low and then sell high. But a lot of people in investing actually do the opposite. And they just can't handle it when their stocks go down 30 or 40%, and they go out and buy companies that are up 30 or 40%. Mathematically, that will destroy your portfolio. What we do at Stenger Family Office from time to time is we may sell a stock that's down 30% to capture a tax loss, but what we're looking for is a stock that's very similar that's also down 30 or 40%, because if you don't go into a stock that mathematically is down about the same, it will crush your portfolio. Don't buy high and sell low. That is the exact opposite of what you want to do. Number 5, talked about this last episode, swimming naked, putting leverage on your portfolio, putting option spreads on your portfolio, doing all the things that look really good when times are going well. But then as soon as conditions change, as soon as the tide goes out, like Warren Buffett said, you find out who's swimming naked. If you have leverage, if you have a ton of personal debt, business debt, whatever it is, it looks really good when times are good. But it looks really bad, and it can wipe you out when times get tougher. So watch your leverage. We talked about this last week. Watch how much you have exposed. Watch your spending right now during these times. Keep your balance sheet towards the asset side, and watch your liabilities. Watch the expenses, because that's how you protect yourself when the tide does go out. Number 6, this is one of my favorite ones, paying for advice you don't take. If you're working with a financial advisor and you're paying them for that advice, presumably, you should be taking that advice. Why would you work with a financial advisor if you're not going to take their advice? Why would you go to a doctor, ask them for their advice on something, and not take it? Why would you do that with any profession? If you're going to pay for advice, you need to actually take it, because there's a reason why when you're with somebody who's a fiduciary advisor who's been doing it for a long time, there's a reason why they're telling you the things that you should do, because in our case, at Stenger Family Office, it's time-tested. We've seen people blow themselves up over the years. So the advice we're giving you is advice that spans 4 decades. We've seen anything and everything you could possibly imagine. We've seen people make really bad decisions. We've seen these 7 behaviors play out in real time. And that's why we're telling you to avoid them, because we're trying to save you from making the same mistakes that people have made for decades. Okay, so number 7, last one, and I think this is probably the most damaging out of the 7, is watching too much news. Why? Just conceptually, news is always backwards looking. It's never forwards looking. There's never a host on TV that's going to tell you what's coming tomorrow. They don't know, just like we don't know. What we go off of is data, math, and statistics. We don't care about yesterday. We don't care about what happened last week, last month, last year. We care about the future. And the stock market is one of the few places on earth that actually is predictive. It tells you what's coming. There's really 2 main factors, and I did talk about this last week, but I'll cover it again. There's 2 factors that let you know where stocks are headed, where the economy is headed in the future. One is corporate profits. What are companies doing with earnings? And if their earnings are going up and you're paying the right price for those earnings, the stock price will follow. It will eventually go up. If earnings are going up, stock price will go up. If earnings are going down, doesn't matter what happens in the short term. If there's a momentum trade and people are crowding into these risky companies with no earnings, eventually the tide will go out, people will figure it out, and then the stock will go down. So that's number 1 predictor of what's going to come is earnings, company profits. And number 2 predictor, and this may be just as important as earnings, is the Fed. And I think that's actually what's happening today. We're seeing more of a Fed sell-off, which this is going to sound ridiculous, but I think we're seeing more of a Fed sell-off today than we're actually seeing with the Iran sell-off. Yes, it's a problem. Yes, oil it's not good that it's over 100 a barrel and all that. We know that. But in the grand scheme of things, it's much worse if people think the Fed is going to be tighter on money supply for longer. And we just had a Fed meeting this week, and people said, well, it looks like the Fed's not going to cut. No big surprise here at Stenger Family Office. And what I would tell you is I think most of the market today is still digesting the news of the Fed. We're going to get past this just like we always do. Powell gets on TV, starts talking, markets up. By the time he's done talking, the market's down. But we're going to get past this just like we do every Fed meeting, and markets are going to digest earnings. They're going to digest the future path of interest rates, and we're going to have a different Fed chair coming up here pretty soon. So the most damaging thing that you could do is look backwards instead of forward. Looking at the news is looking backward. The news is not going to tell you anything that's going to help you profit long term, because by the time you read it, it's already too late. What you want to do is look into the future, and that's the Fed, and that's corporate profits. So we're in a 6% pullback. I have been telling you week in and week out, we're probably going to end up at a 10% correction all in, maybe 15, but I think probably where we end up is about 10%, and that puts the S&P right about 6,300 points start to finish, and to me, that is a screaming buy. In fact, I would say today is a pretty good buy, actually a really good buy, but at 6,300 points is a screaming buy. And I told you the same advice last year during tariffs. I told you S&P at 5,000 5,000 is a screaming buy. But even if you didn't pick it up at 5,000 and you got it at 5,300 or 5,500, who cares? You're still up significantly since that pullback last year. You're up 20-25% still. So don't worry about these short-term moves. Look a year out. Look 18 months out. Look even 2 years out. And ask yourself this question. Do we think profits are going to be up 2 years from today? Do we think interest rates will have moderated 2 years from today? And if the answer to those two questions is yes, I think the stock market's going to be up. We have continued to maintain that 7,700 target on the S&P, and I don't know exactly when we hit it. Maybe we hit it in 10 months. Maybe we hit it in 12 months or 14 months. But that's the fair value on the S&P, despite what happens geopolitically. So stay on your plan. Use this as a buying opportunity, and I think when we get past it, it's going to be the same story that we've always heard. Buy stocks when they're on sale. Every single one of these corrections, without exception, for the past 200 years has been a buying opportunity for patient investors. Thanks for being on episode 215. We'll see you next week for 216.